Welcome to the Harvard Lifecycle Calculator training. My name is Joel McKellar. I'm the Assistant Program Manager for Harvard Green Building Services, and I will be walking you through the use and kind of underlying assumptions behind the Harvard Lifecycle Calculator, which is a 100% free resource that is available both to the Harvard community and the wider public, available on the Harvard Green Building resource, which can be accessed via green.harvard.edu online. This training, as well as many other trainings, are going to be part of an update to our green building resource that we hope to launch within certainly the next few months or so, that will be available to everyone, and we would encourage you to check that out when that is available, because it will feature much more information related to LEED certification administration, energy auditing, building commissioning, measurement and verification, and really a variety of topics as they relate to new capital project construction and existing building construction throughout Harvard University. So with that in mind, let's continue with the life cycle training. Broadly today, as I mentioned, we're going to focus a brief introduction to life cycle costing in general. What is it? When is it required at Harvard? Why do we have a specific calculator for Harvard? And what are some of the features of that calculator that make it especially useful here? We will not get into how to manipulate the calculator for use outside of Harvard. However, by and large, the energy rates would be kind of relatively common and could be reused and are fairly easily editable if you get into the cost assumptions sections of the tool, and I'll show you where that is later. But most of the time is going to be spent looking at the calculator inputs, what information do we need in order to generate one of these reports, and the outputs. So once we have the report, how do we analyze the results, both from an economic and greenhouse gas reduction standpoint. And finally, I will be switching back and forth to do a sample exercise from a real analysis we performed at Harvard recently that shows kind of why we do this in the first place, because it was something that was driven not by energy savings, but there was real maintenance savings benefits that made the project much more feasible, as you will see. Energy savings are important, obviously, but sometimes they're not the whole picture, and that's really why we start to get into this. With that in mind, a basic definition of life cycle costing is something that's going to really give you the full cost of ownership of a given energy conservation measure or system measure that you're considering implementing over a set period of time. Harvard uses 20 years. That was not an arbitrarily arrived at time frame. One being the owner and operator of our buildings. It makes sense for us to look further out into time, but not necessarily infinitely into time, because at some point your assumptions start to break down in escalation rates, in cost of materials, and just your ability to predict new technology. So the 20-year assessment was done was done to highlight the length of time that much of the equipment we would be analyzing related to energy conservation measures will last. Mechanical, HVAC, those sorts of equipment, solar panels, all tend to be somewhere within a 15 to 25 year range. Obviously, there are exceptions to that, but as a general rule, it's a pretty safe assumption. So this 20-year time frame is good because it has us look out far enough where we're really considering the life cycle of a piece of equipment, but not so far that we're going to be influenced to make purchasing decisions on technology that won't pay back, let's say 40 or 50 years. There may be an increase in technology in that time, in that interim, where it might have made sense for us to wait and pursue something else. So 20 years is kind of a good balance. And just because we're looking at 20 years doesn't necessarily mean we would accept everything within a 20-year payback. We'll talk about the analysis side and kind of what guidance there is for accepting in a moment. But basically, this includes everything: our utility costs, our operations and maintenance costs, our replacement costs. We're not looking at just one piece of information in what has historically been a very first cost-driven industry. So when is it required at Harvard? Harvard has a set of university green building standards that were established in November 2009 that require life cycle costing in three separate situations. One would be a new building or building-wide full gut renovation. So this is a ground-up facility, something completely new, a complete overhaul or major renovation. For those familiar with LEED, sort of a LEED for new construction type project. In that situation, as well as the building interior fit out, which is more of kind of a lead for commercial interiors fit out, where you would be working with some systems but not necessarily the main mechanical systems. Typical projects at Harvard for that would include we have a new professor who's a research professor, and we're outfitting their lab space. Or Harvard Real Estate might have a new retail tenant, and we're outfitting a retail space for them, but not the larger building. So those are both two situations that are really capital project oriented. You're likely to have an architect and engineer, and so we have level 1 requirements for LCC for those. And what I mean by that is that it's not just a one-time thing. You're looking at life cycle costing at different phases. So an early phase might be a consideration of going with ground source heat pumps versus a boiler system. That's very macro, kind of what kind of energy system are we going to use to provide heating and cooling. Later on in the project, we might get much more specific and look at, okay, we know we're going to have insulation, but we want to kind of maximize the effectiveness of that insulation. So we might look at 6 inches of insulation versus 4 inches versus 8 inches, and look at the relative costs and kind of components of that, and have a much more refined kind of view of what's going on there. So there's different phases, would require different things depending on the issues you're looking at that time. Another situation where we would require LCC would be for our limited scope projects. And by those, we tend to mean just kind of straight energy conservation measures. So for instance, we would potentially be looking at boiler replacement or the installation of variable frequency drives on existing equipment. Any number of things. It could be lighting replacement. So these are your typical, if you were to go in and do an energy audit, we would have specific measures that would be recommended, and we would vet them once we had costing information using a single LCC. So in those cases, you're not really doing multiple iterations. Typically, you just have a single one version of the LCC that would be done. So why do we use it? There's a number of reasons we use the life cycle calculator, and many of these will become more apparent as we actually get into the use. The first one is that initial costs are deceiving. So it's very easy, especially on capital project teams, to just kind of look at that big number at the bottom, which is how much is this going to cost me overall, that big initial cost. And it's going to be a very large number in most projects. So the notion of, well, I could cut out $700,000 from my lighting budget if I switched from LEDs to fluorescents, for instance. Or, we could go with a non-condensing boiler and save 15% on our HVAC costs. Well, those initial costs, while they represent big savings, those have big operating cost impacts. So we really want to look at the full cost of what's going on and what those decisions are doing to our long-term cost frame. So those operation costs can have a big impact overall. When we look at a building over 30 years, for instance, if you take particularly energy intensive buildings, those operating costs, which only seem like $1, $2, $3 a square foot a year, which seem relatively small, add up over many years and many square feet. When you look at restaurants, it's very common for the utility costs, the amount you'll spend on energy and water, to exceed the entire cost of construction of that building in as little as 30 years. When you're adding up those costs over time, when you throw in maintenance factors for replacement, wear and tear, all of those sorts of things, we end up with a situation where many building types, not even the energy intensive ones, can begin to equal their initial construction cost and the time frame of decades. And I think most people don't really understand that when they're just looking at a capital budget. You're seeing this huge giant, $50 million number on a large building, $5 million, whatever it may be, even on your house scale. Hundreds of thousands of dollars, it can be equaled by your energy and maintenance costs over a relatively short period of time. So we want to really understand those costs when we're making decisions. The other thing is that today's money isn't equal to tomorrow's money. So everything in the life cycle calculator is affected by what's called a discount rate, which we'll explain in a little bit. But essentially what that means is a dollar today, if invested elsewhere, could be worth more money in the future. And so every piece of savings we show in our life cycle calculator, we actually discount a certain percentage in order to account for the fact that what if we invested this in the Harvard endowment or elsewhere? We would expect a certain return on investment. So we'll talk about that rate and how that was set in a little while. Simple paybacks aren't the full story. Even if we're going beyond just looking at initial costs, often people will just look at, okay, if I am going to save $50 a year and it costs me $5,000, that's a really long payback. But if you're factoring in maintenance savings and other things like that, rebates and incentives, those sorts of things can really have a big impact. And finally, the reason we use this calculator at Harvard is because we're able to make it specific to Harvard. Harvard has some district utility systems that would be kind of hard to really understand outside of something specific to Harvard. And all of our rate structures, escalation, discount rates are consistent. So whether it's the business school or the law school or the extension school that's doing an analysis, by using the same calculator, we end up with similar results, and we know we're getting equivalent comparisons across the different departments, which is very important. And then finally, why do we use it? So Harvard has a greenhouse gas reduction goal of 30% by 2016 from 2006, inclusive of growth. This is a tool, and one thing that's uncommon about our calculator that you won't see in other published life cycle costing calculators is that we assign a greenhouse gas emissions factor to all of our utilities. And the result of that is we can provide a set of analysis tools that are looking not just at the economics but at the greenhouse gas side of the equation as well. So we're getting information providing both of those. And then we're even able to blend those and look at what is our investment cost per ton of greenhouse gas saved, or what is our total net present value per greenhouse gas saved. That allows you to analyze across credits in a very simple way in a cross measure. So if we had multiple analyses we were looking at, we could very quickly determine how our money is best spent in reducing our greenhouse gases, not just at the best return on investment. So there's multiple ways we can look at these things. And as I mentioned before, it's a means to link the capital budgets to the operating budgets, which is a really critical need for anyone who's going to both own and operate their buildings. We do have a set of financial guidance included in our calculator. I'm not going to go into this in detail right now. Basically, it directs you to use different types of analyses depending on your situation. So for one of the things we looked at, I mentioned district systems earlier. One of these things that this calculator does not do well is provide a really macro level analysis of the decision of whether or not to use Harvard district's utilities or Harvard, or to make your own heat or chilled water on site using traditional methods of chilled water cooling towers and chillers or boilers. The reason for that is there's fixed costs associated with our district systems, and I'll go into this in more detail later. But suffice it to say, for right now, we really want to direct teams not to use our calculator for make or buy decisions, as I just described. You really need to complement that with a better understanding of how exactly the rates are provided, and we'll talk about that later. Additionally, there's a big distinction between mutually exclusive ECMs and those that are not mutually exclusive. So what I mean by that is this. We could be building a new building, and we're looking at the impact of cheap, inefficient windows versus double pane, argon filled, very efficient windows. At the end of the day, those windows are going to be installed. One of those things is going to be chosen. And one of those, we're going to have windows in the facility. So one of those options is going to be used, and they're mutually exclusive. So we're either going to choose this item or we're going to choose the efficient windows. The junky ones are the good ones. In that case, we just want to have the one that has the lowest net present value. And what I mean by that is whatever has the lowest total cost, the highest net present value or the lowest total cost of ownership. And we'll get into that in a little bit. There's another instance though where if we're looking at a retrofit situation, they're not necessarily mutually exclusive and they're not necessarily going to be installed. So for instance, if we had an existing building scenario, we might look at it from a different perspective in that we want to see a good financial investment of this money. If we're assuming limited funds and we have multiple options at our hands, we want to choose the ones that are going to give us the greatest return and have the greatest GHG reductions for the lowest amount of money. In that situation, we want to show a good savings to investment ratio so that the amount of savings we're receiving is well in excess or at least equal to the amount of money we're putting in. In the net present value situation, you could have a terrible savings to investment ratio, but if you still want to choose the one that's costing you the least amount of money overall. You're still going to spend some money regardless. So those are kind of some slight discrepancies, and we'll cover that a little further in the analysis. But those are kind of the key issues where you need to examine what type of project you're using. That's going to affect how you interpret the results. So getting into the assumptions a little bit. We have a series of assumptions both for our discount rate and our escalation rate. So as I mentioned before, the discount rate is essentially the time value of money. So if I invested $1,000 today and then I had if I invested $1,000 in the Harvard endowment, let's say, they've been averaging roughly 8% returns. And so that has been used as a proxy for what our generic kind of theoretical investment would be. That if we let this money sit in the endowment, it would probably be earning us somewhere in the neighborhood over a long period of time about 8% a year, which is a fairly good return. If you look at corporate life cycle tools, so for-profit companies, they typically want a much better return on their investment. So it's not uncommon to see discount rates in excess of 15 or 20% on the corporate side. So Harvard is already being reasonably conservative with our discount rate. Although, as you'll see how this really works, it's worth kind of understanding this figure because this is eating away at our savings at every year. So if I invested $1,000 today in the endowment, it's basically saying the amount of money I would have in year one would be $1,080. And if my utility savings I'm getting from investing that in an ECM is less than $80 and all else is equal, then it would say I am net present value negative. I'm not earning money. So it would show a zero savings overall because it's comparing against that 1,080 from the discounted funds, not the 1,000 I initially invested. That'll become clear as we actually manipulate the calculator, but I'll show you in a bit. Our study period is 20 years. That's fixed for this calculator. It can't be changed. Right now, we also carry a cost of carbon per metric ton of carbon dioxide equivalent. We currently have a value of $0. So this is really a placeholder where if we ever had carbon taxation or a carbon trading market where Harvard started taking advantage of those things, or if we started buying carbon offsets, and so we were committed to basically buying carbon offsets for anything we weren't able to reduce in actual emissions, there would be a cost associated with that. So we could add that to the cost of our utilities, which could provide additional savings when you look at it from using less of those utilities perspective. So that cell is 0 on our standard calculator, but it can be edited and it will function if you want to play around with that. We also have a number of escalation rates embedded in our calculator. So what these are doing are saying, for instance, we expect our utility costs to rise by 4.33% per year going forward. We expect the cost of materials to rise, but at a lower rate, 1.84%. We also use that for our maintenance costs. These are developed in collaboration and reviewed on a semi-annual basis by the Harvard Finance Working Group and Harvard Engineering and Utilities, looking at the utility side. So these are updated periodically. They tend to stay reasonably constant. You're not going to see giant swings here typically, and we've kept the discount rate fairly constant for a long time as well. But these are applied to any costs we have going forward, and you will see how that functions in a while. So as I just mentioned, our maintenance and materials cost escalation rates at about 1.84%. That's from the Energy Information Agency's estimation of inflation, and we currently our engineering and utilities department has our escalation rates for utilities at roughly 4.33% per year. And again, this is over 20 years. So and this is, looking long term. Obviously, there's going to be higher variability, but you have to make some basic assumptions about what's going on in the future. So looking at the input side, and we're going to start to get into the calculator very shortly, we have it's a pretty simple set of things you're going to need. The key takeaway here, though, is that this information isn't just embedded in the calculator. You can't go into the calculator and say, oh, I'm doing a lighting project. Tell me how much energy I'm going to save. You have to do some research into your measures ahead of time. So it's expected that you're going to know the costs, you're going to know potential incentives, you're going to know the replacement costs, you're going to know the amount of utility consumption or energy consumption there's going to be, and the ongoing maintenance costs. This information has to be prepared and ahead of time. It can be done on capital projects working with your engineers and your contractor. It can be done working with vendors or any sort of provider. Typically, anyone doing an energy audit will be handling a lot of this information for you. In fact, you can take most energy audits and enter them into a life cycle calculator and get a 20-year kind of payback. We use our life cycle calculator for the energy audits that Green Building Services provides in a limited fashion, mostly just to get the saving, those kind of financial metrics laid out. The GHG savings and those things are determined elsewhere. So with that in mind, let's jump into it. So this is what our calculator looks like from the front page, and what I'm going to do is I'm going to hop on over to the actual Excel sheet. Everything's in Excel. And so I want to give just some general overviews of the use of this calculator. First and foremost, down in the tabs, they're pretty easily labeled and pretty easy to follow. So we have a large instructions thing. This has kind of that flow chart of decisions I've mentioned before. It talks about the distinctions between independent ECM projects, mutually exclusive ECM projects, things that involve district energy, plus a very detailed list of each of our results pages analysis metrics, how those are calculated. I'm not going to go into that in great detail right now. Again, we will see that later, but just know that all this is here in one page where you can look at it. There's another way you can look at it, however, by going to either the inputs or the results pages. You'll notice most of the Excel sheets have a red triangle with a comment over it, each of the cells, and that describes what's going on in that cell in some detail. Often, in the case of the results page, just copying what I had just shown for each of those results. So it can tell you what you're looking at, some guidance as to what is good or bad. For instance, for SIR, if we have an SIR of 1, it means the project saves just as much money as it costs over 20 years. An SIR of 2 would mean it saves twice as much because it's a ratio, and so on and so forth. So we have some helpful information within each of these cells. And that's true on the inputs as well. Total cost, incentives, how you enter that, why do we distinguish between materials and labor, which I'll get into shortly, for your annual consumption, what units are we doing, how do we use our custom field, which I'll describe in a bit as well. So with that in mind, you should only be filling out tables or cells that are highlighted in green. So we could put just some sort of orienting. We could talk about the Harvard Extension School. We could talk about different buildings, project name. This is going to be an LED microscope, so probably actually not something we would see too often at the Extension School. I'm actually pulling this from some analysis that the Harvard Medical School was looking at and looking at purchasing decisions for some of their lab microscopes. And this is a process energy project type. So that's just kind of some general use of this calculator. You can put a date in, which I'm going to do. And note that it says the calculator was last updated in July 13th up here. We do have periodic updates to update our rates, our GHG emissions factors, and escalation and assumptions. So we went over those earlier. Some of the escalation rates have changed from that slide. I need to update that. But you can see our different rates for chilled water, steam, water, and so on that were developed by engineering and utilities and are carried through. You can edit any one of these cells and they will work. However, if this was being done for Harvard, we want everyone to use our standard escalation rate. So we're seeing apples to apples comparisons. Finally, there's a big reset button. So you could change all of this stuff to whatever you wanted it to be. You can always hit the reset button. It's going to clear everything out and get it back to normal. So you can always start from scratch or download a new copy. So we have the inputs tab, which I'm going to go over first, and then we have a results tab, which we'll go over second once we have some stuff in our inputs tab, and that's pretty much it. There's other sub-tabs that have a lot of the calculations and details of the savings. You can see there's a lot of information in here, although frankly, it's presented in a better format on the results page. There's not a, you can see year over year here if you really want to get to that level of detail, but most of these are just rolling up into kind of sum figures in these tables, which we'll go over later. So again, you're welcome to use these if you want a lot of detail. Generally, we recommend you should just be staying in the green stuff going forward. There's no need to edit those other things unless you're trying to adapt this calculator for outside of Harvard use, in which case you really should just be editing the price and GHG detail. You can just go through, change these rates. You can see these white cells are the ones that need to be edited. The gray cells are the ones that would be just automatically carried forward using the escalation rates. So that's that. Now, back to this. So broadly, we're looking at costs, both from initial costs, our replacement costs, our one-time operating costs, and then consumption. If you have those pieces of information, you have what you need to complete this calculator. So starting off with the initial costs, the first thing we want to do is enter the total cost, or the initial kind of upfront cost. So this includes labor and overhead, it includes everything. It's just that big upfront expenditure. This is looked at differently than ongoing maintenance and investment costs, and it's looked at differently than replacement costs in some of the calculations, which we'll discuss in the results section. If incentives are available, you want to enter them in the incentive box, which will create a net cost for the initial project. For those, we have a green revolving loan fund at Harvard, and people are required to use this calculator for their analysis, and they're also required to investigate if incentives are available. The state of Massachusetts, through NSTAR, NGRID, and the Mass Save program, actually has a fairly robust set of incentives, both custom and prescriptive, that we spend a lot of time at GBS doing incentive management for our capital projects, and can often, frankly, provide or be able to collect incentives that are in excess of our entire fee for our involvement in the project. So it doesn't always work that way, but they can be pretty large. They can be pretty large returns, because in Massachusetts and elsewhere, the way it's set up is that the utility companies have quotas for these sorts of things, and they have financial incentives to give you incentives. So it's kind of, they get paid based on the amount of money they're able to give out, which is an interesting situation, but it works really well for the consumer. Finally, we have replacement costs and expected life. So as you'll see, we'll enter those now. That's looking at the lifespan of the equipment, which we will go over right now. So as I mentioned, we are doing a incentive project where we're looking at LED microscopes. So broadly, what I want to understand is we're going to look at a baseline and two alternatives. The baseline we're going to assume is the biggest consumer. It's a metal halide lamp that is 200 watts, so pretty high powered lamp in order to provide these services. For the microscope, the lighting for the microscope. There's also mercury vapor lamps that are slightly less in consumption, but as you'll see, carry pretty high bulb costs. They're expensive. And finally, we're looking at an LED microscopy option. I do have a specific vendor that we've earned or gotten some of this information from. I'm going to keep it generic for the purposes of this presentation, and we'll be using slightly altered costs just so you can see. So this isn't specific, although this type of product does exist. So with that in mind, let's look at our baseline costs. So we're just going to look, for theory's sake, at a single LED microscope. We're going to assume, for the purposes of our costs, that this microscope and this lighting system is already in place. So our total cost for the baseline is zero, because we already own it. There's no additional costs incurred as a result of that. The result of that, there's no incentives for an existing system, and our net cost is zero. For the mercury vapor lamp, we actually have a cost of $3,500 to purchase that, and we, as you see, we'll get some energy savings. There's no incentives available for the mercury vapor lamp. And finally, the LED microscope is going to come in at a cost of $8,000, and we do have some incentives available for that. I'm not going to go into the calculation. It's actually quite small on the per lamp basis because this is a custom measure, but it's somewhere in the neighborhood of about $30. So the incentive in this case isn't doing much, but it's not hurting either. Now, replacement costs is the big item here. So for the metal halide and the mercury vapor lamps, these are both going to last. The lamps themselves are going to, excuse me, the fixtures themselves are going to last a long time. However, these lamps have a very low lifetime. They can last about 2,000 hours, and it just so happens that based on some information we got from the medical school, that they're using these things about 2,000 hours a year. So with that in mind, we actually have a 1-year life on these lamps for both the mercury vapor and the metal halide. Now, you'll see too, when I hit the mercury vapor, it went ahead and automatically inserted $3,500 because that is what the net cost, or excuse me, what the total cost was, is automatically duplicated here automatically. You can overwrite that though, which is what we're going to do, because we're not actually replacing the full system. We are replacing just the lamps, but these lamps happen to be about $1,500 a piece. So there's a very significant cost there for the mercury vapor. The metal halide lamps are less expensive, but they are about $700 a piece. Now, I should be clear, this is not normal type of household lamps, obviously. These are very expensive bulbs that have very specific light characteristics that are needed for the microscopes. Frankly, I don't have a lot more detail for anyone other than that, but just understand that these are not your kind of run-of-the-mill bulbs, and these costs are actually somewhat realistic. We pulled the metal halide costs actually looking at average costs spent by a lab, so we're pretty confident in those. Now, the LED microscope, also, we're not replacing the full fixture, but these last 20,000 hours. So we're actually getting 10 years of life out of this, and the replacement cost isn't $8,000. It's actually closer to $2,000. So we're replacing the entire LED light engine. Again, it sounds like a lot of money, and it is, but you can already begin to see when we start to factor in the material costs, $700 a year adds up to $14,000. $1,500 a year adds up to $30,000, whereas we basically have $4,000 in costs with our 10-year replacement schedule here. So we're already much lower there and making up a lot of the difference. So that pretty much covers our inputs for our cost side. We factored those things in. Other things you might want to look at, commonly found, are what are some of the labor costs associated with this. So there's not a ton of labor. We would look at bulb replacement. Presumably replacing this bulb is just effectively free. It's just one bulb, we just pop it in. If we're looking at large-scale fluorescent lighting, lamp replacement can be very big. You could have a facility with thousands of lamps in it, and even at 5 minutes per lamp, that adds up to hours and hours of labor that you have to do every time. It's actually one of the big drivers of LED savings is frequently the lamp replacement schedule. This is not an uncommon. The scale of the numbers are a little strange, but the general concept of the LEDs far outlasting their counterparts is very common, both at the process kind of microscope level and at your typical lighting scale as well. So let's go ahead and switch back over to the presentation. We've covered that side, and pretty straightforward information there. So just some to fill in, NSTAR locally has very good application forms, pretty easy to navigate. I've provided the link here, and you're welcome to take it and look at what they have. They do update these fairly regularly at about an annual basis. For instance, our lighting power density savings just went up 20% per watt saved, which is good. So it's always good to kind of check in and look at what's available there. Plus it's important to understand too that you have a custom application that if you can convince their engineers essentially that or justify your energy conservation measure, regardless of what it is, even if it doesn't fit into one of these lighting, cooling, process loads or other categories, you can get savings for pretty much anything as long as you can provide a defensible metric either through an energy model or just kind of back Excel-based engineering calculations using good engineering kind of cost assumptions. So or consumption assumptions. So that is available. We talked about one-time and operating costs and the inputs. One thing I do want to point out that is a difference. So there's a reason we divide materials and labor, and that is the remaining equipment value in year 20, which I'm highlighting below. So what this is talking about is basically saying, okay, if I spend $10,000 on something in year 15, and I expect that to last another 15 years, there's a value of that equipment that is remaining in year 20 that would be roughly equivalent to 10 years of its remaining life. So let's look at this. So right now we're at 10. What if we said this $2,000 over here was actually going to last 15 years? So we have a $2,000 cost in year 15, but then we have a total cost of that. However, in year 20, we have a remaining equipment value of $1,333 because there's still a fair amount of savings that are going to be expected there. So going back to our 10-year, you'll see when we make this payment in year 20 of 2,000, we're going to have about the full life of that equipment left. So we have a year 20 remaining equipment value of $2,000 there. So this money is actually given back to the project in year 20. So it's not, you're not penalized for buying something late in the later years and having all of that value stored up, because if this was a really large line item, that could have a huge impact and make our net present value go artificially lower. So we have a mechanism by which we can return those costs in year 20. So we assume that materials will have a remaining value, and this is built off the expected life and replacement cost. We assume any labor, however, the second it's used has no more residual value. So any labor costs are just spent, and there's no real ongoing savings that are associated with those. So for whatever reason, we had a $1,500 cost there. That $1,500 is there. It's going to have no effect on my remaining equipment value going forward. So just that's our distinction between the labor and materials. Theoretically, our labor and materials could escalate at different rates. Right now, they're being held the same. So no big change there. So we've talked about this: material costs, labor costs, remaining equipment value in year 20. One of the things we're normally struggling to find actually are those maintenance costs. I wanted to point out the availability. There's Whitestone Research seems to be the only company or that we could find that has a facility maintenance and repair cost reference that's based both on system and type of building, and kind of gives you an outlay of when you would expect to replace these systems and so on and so forth. One thing you might notice is we have very large costs in year 20 and year 15 and year 10. And that goes back to kind of our replacement period of the 20-year period. They do have their peak ones in year 30, driven seems by a lot of electrical work and a couple other things, but these are costs per square foot. And look at these costs per square foot. I mean, we're seeing mostly, most years it might be $1 or so, but on these big years, we're seeing over $20, $19, $10. These are substantial costs. And so if you can get something like a flooring product, for instance, that's not going to require a ton of maintenance or a rapid replacement schedule, that can have a big impact on your long-term costs. So, kind of examining the terrazzo versus the carpet, things that these are good items to kind of profile. It doesn't necessarily have to have an energy component for this calculator to prove useful. So keep that in mind with any of your kind of capital projects. Next, we need to get into the annual consumption. So this is, even though I was just talking about how it's really set up for a lot of projects, anything with a maintenance component, we're also set up very much for energy conservation measures. So in Harvard, for the Harvard calculator, we have different rates at Cambridge versus our Longwood campus, which is a medical school campus. We also have certain properties that are direct build. through NSTAR or National Grid, both in different rates for residential and commercial district electricity. Natural gas costs, whether you're in Cambridge or Boston. We also have district systems, both at our Cambridge and Longwood campus. So we have rates for chilled water that's supplied per ton day and steam that's supplied per MMBTU. You'll notice all of these units change. So we look at natural gas in therms, we look at electricity in kilowatt hours, we look at water in 100 cubic feet. So all of these things are set up. You just enter the common unit, the consumption, all the costs, and GHG is taken care of for you. You don't have to worry about it. So you just need to know those potential differences in savings and costs. As I've discussed multiple times, the LCC isn't going to calculate the utility savings for you, and you're going to need to work with someone to do this. Also, the location is important. As I mentioned, Blackstone Steam versus Longstone Steam has different, or Longwood Steam has different rates. And by Blackstone Steam, I mean just the main Cambridge and Alston campus steam plant, which is at 46 Blackstone Street, which is where our office is, coincidentally. So that's what I mean by Blackstone Steam when I refer to that. So going back to our example, we need to talk about it. So basically, we need to enter the amount of electricity that each of these are going to use. So this is a reasonably simple calculation that I'm just going to talk you through. So we know the watt hours, or the watts that are consumed, which is a unit of demand for each of these materials, and we know the runtime of those. So then from that, we can fairly easily get to our total kilowatt hours per year, which is what we're doing. We're putting annual consumption in at every level. So starting off with our metal halide, we're starting off with 200 watts. To convert that to kilowatts, we divide by 1,000. And then we said we were operating this for 2,000 hours a year. So to get kilowatt hours from kilowatts and hours, we just multiply the two. So we actually end up with 0.2 times 2,000, and we end up with 400 kilowatt hours. I could go through that same process again, or I could just note that this is half the wattage of this, so we're going to end up with half the kilowatt hours of this. So we end up with 200 there. And finally, we're doing the same thing with our LEDs. So we have 4 divided by 1,000 times 2,000, and we end up with a total of 8 kilowatt hours for that. So already we can start to see some of the scale of our changes. So in year 1 today, and notice I put Longwood Electricity because this was a project on the medical school campus. We would see slightly different rates at the Cambridge campus. It's a little less expensive. If this was a residential project, it would be more expensive, and commercial would be somewhere in between. So where you are matters with respect to all of these things. So the Longwood, we've got $59 in cost, and we dropped that all the way down to $1 in cost with our LED system. So on a percentage basis, we actually have a very large change in costs overall. I mean, obviously we're 1/59th essentially of the cost of our metal halide system. However, that's still just $58 a year, and this gets at the essence of why we use life cycle calculation. If we took that $58 a year and divided that by our initial cost difference into our initial cost difference of $79.70, what we end up with is a simple payback period of 134 years. So that is not a terribly good simple payback period. So that's something we want to look at if we just consider those two metrics. But when we consider the maintenance, it's a different story. And I'm not going to get into that just yet, but let's walk through some of these results, and then we'll come back to what we found. So we've got all that entered. Oh, one other thing I wanted to show on our inputs tab. So we do have set in a custom calculator. So this could be widgets, this could be pretty much anything you could imagine. So I could just put in 10 of something here and 5 of something here, and then you'll notice there's the custom cost per unit and the custom greenhouse gas per unit. So I could make this $100 per unit, and so that would be $1,000 there and $500 there. I could make this $1 per unit, and so on and so forth. And I can also assign a GHG factor to it. So, we could see changes in our GHG production, our emissions based on those units as well. So that could be used for anything, and that's a actually super quick way if you just have one variable and you're trying to use this calculator outside of Harvard. Really, the materials and cost side, this shouldn't need to change for any user, really, regardless of where you are. It's really just this stuff that might potentially have a need for serious changes. But yeah, if you've got one thing, you could put in your electricity rate. So say your electricity rate is 16 cents. We could drop this down 16 cents per kilowatt hours. We could just put this column here and be done with it that way. And it'll calculate everything else the same way. So just know that that's there for those of you not specifically at Harvard full time. Okay, so moving back to our presentation. So our output basics. We basically set this up into, you have information on your costs. What is your total cost of ownership? And that is provided for both your baseline and each of your measures independently. So just a total sum of everything. How much is this going to cost me to own for 20 years? And then we look at net present value, which is the savings. So that's looking at my alternate. How much is my LED saving me relative to my baseline? The baseline in all situations is always, for the purposes of this calculator, is whatever's in this column. I overwrote this and wrote metal halide just for the sake of keeping it clear. But this is always listed as baseline in our initial versions. It's always going to be referencing back to that. And as we get into the results, you'll see, so we provide really two sets of results because we have two alternatives you can consider. You don't have to use both of them, you can use just one. So up here we have our baseline 20-year total cost of ownership. We'll talk about cost of university and cost of building in a moment. And then we're comparing the baseline to the mercury vapor, which is all of these metrics. And then we're comparing the baseline to our LED microscopes. And we have all of these metrics. So going back to our presentation. So what are some of the key metrics? Obviously, the total cost of ownership is a big one. That's kind of your budget item. The financial savings is a very big one too. How much are we saving? And this is the one we want to really focus on for mutually exclusive projects where we're going to do something we want to figure out really, and that's just the same thing as saying which is the lowest total cost of ownership. That's what we should pursue. When we're talking about things we don't necessarily have to do, we really want to focus on the savings to investment ratio. So how much savings am I getting per dollar spent in investment? And the higher that number is, the better off we all are. The notion of simple versus discounted payback periods, we'll discuss that in a second. And we also have a suite of greenhouse gas metrics, specifically looking at the greenhouse gas emissions and the financial performance of potential greenhouse gas savings. So we can look at that both from a financial and a greenhouse gas reduction perspective, which Harvard does take very seriously. That's one of the biggest benefits I think of working here in the sustainability field is people do pay attention to those greenhouse gas metrics. Every once in a while, not very often, it makes sense to potentially pursue something that has a great reduction in emissions, even if it doesn't have the best financial payback. So an example of that would be, we're doing a major overhaul of a building that might be uninsulated. It's actually kind of hard. Retrofitting anything is very expensive. If we were just building a new building, the cost of insulation is relatively cheap, but to pull away interior finishes back to the studs or back to the wall and then come back and insulate and then have to completely recreate that wall again is a very expensive endeavor. But there's a huge impact, obviously, to insulating buildings. So it's something that you're only going to do a major renovation project like that on an existing building probably once every 50 to 100 years, depending on the type of building it is, especially on a historical campus where we want to preserve as much as possible. Sometimes it just makes sense to do it even though the payback might be 20 or 30 years because it'll probably be lasting 50 years and there's no other opportunity we'll have to make that kind of a greenhouse gas impact. So again, this is only one piece of the tool in any decision-making process, and we'll cover some of this coming forward. So I just showed you we do have, this isn't the example we've been using, it's just a slide from another example, a hypothetical example of some savings. So as we discussed, we have our total cost of ownership for our baseline up at the top, and then option A We're looking at the total cost of ownership of that, the net present value, which is just the total cost of ownership of our option subtracted from the total cost of ownership from the baseline. So the difference between 147,000 and 116,000 is 30,823, and our total GHG savings over 20 years, so 300 MTCDEs, pretty large one. Then we have simple payback. So the key thing to understand about the simple payback is this is looking just at year one. We are not looking at those ongoing maintenance savings. So in this example, we had almost $3,600 of utility savings. That $3,600 into the difference in initial costs, which it appears to be was about $15,000 or $16,000, was somewhere in the neighborhood of 4.17 years. So that's not accounting for any having to do maintenance or replacement. And we'll see this in our example and walk you through it. Don't worry about these bumps just yet. So these are just kind of the real basic intros. And then we have life cycle metrics, which do consider the kind of full 20-year system, as do our greenhouse gas metrics. So let's see how these work in practice. I think it's time we get an understanding of why we have a difference between savings to building and savings to university. So you'll see we have two columns. This is the university costs and savings, and then we have the building cost and savings. The difference between these two is that the way Harvard's district systems, and this applies only to Harvard's district systems, so our Cambridge Steam, our Cambridge District Electricity, our Cambridge Chilled Water, and our Longwood Steam and our Longwood chilled water. Or excuse me, not even the Longwood campuses, because those are third-party providers. So it's just those three Cambridge systems. The way we do billing at Harvard with our energy supply is that we have fixed costs for each of our systems. So steam has a fixed cost component of about 65% of the rate because there's a lot of infrastructure involved with that. We have investments in boilers, we have investments in distribution, we have investments in kind of ongoing maintenance and personnel to run the plant, et cetera, et cetera. Regardless of whether we use 1 MMBTU of steam or a million MMBTU of steam, those fixed costs remain constant. So if we save money on our consumption, we're not really saving these fixed costs. And so what that means is the way we bill, instead of Harvard just saying, okay, all of the users have to pay our fixed costs up front and we're only going to charge you for the variable cost, we blend the rate. So each year they go through a budgeting process where they say our fixed costs are, let's say, $1 million, our variable costs are $350,000, and so our total costs are $1.35 million, and then we might have, if we have 1,000 units of energy that we expect to sell, we're going to divide those costs together and just create a per unit rate that includes both of these costs. A little complex, I understand, but suffice to say, Harvard is not saving. We're going to shift these costs. If everyone stopped using so much energy, we would still have to pay for this fixed cost. And the variable costs, however, so this is mostly fuel or supply, this does get saved. Both the building and the university save this money. So these things are considered, if we were looking at steam savings, if we're looking at the savings to university, we're really only looking at 35% of that total rate. So by definition, so you see this red line is the savings to building, and this blue line is savings to university. By definition, the red line is always going to show greater savings than the blue line. They might be equal if we're not using any district systems, but the blue line is really representative of the university perspective. The red line is more indicative, however, we bill all of our buildings. So if a building saves all this money, they're actually, in year one, their bill is going to look more like this red line over time. However, because of that cost shifting component, since those fixed costs are reallocated, the reality of the payments over time is that the further along you get, the actual savings to the building is going to be somewhat less than we're showing the savings to the building, but somewhat more than the savings to university. So the real answer is somewhere in between, and we're just showing the range is the goal. When we look at approving funds for our green loan fund at Harvard, we end up requiring them to use the blue line. So they have to show a reasonable payback to the university because it's not just to the building. A little complex, I know, but it has some important implications. The reason we don't see this with non-Harvard rates is because we're just going to get billed by the utilities. That those, if we save a unit of steam at Longwood, Harvard doesn't own that plant. They're just going to charge us for one less unit. So the Harvard University gets the full cost of those savings. Same with direct bill accounts for electricity. Now, this may seem a little weird, like why are we spending these fixed costs? If you'll remember though, by doing it this way, who had the cheapest electricity rates overall? We're able to get a lot of efficiency out of our plants. So there's still a net benefit to sticking with our Cambridge District utilities overall. The university as a whole is benefiting from this. So it's important to kind of remember that fact as we go forward as well. So there's a lot of reasons, and that's essentially why we're showing these two savings, because we want the building to have a reasonable understanding of how their costs are likely to be. However, we want them to also understand how much the university is saving over time as well. So again, this is a hypothetical example. I think at this point it's easier to kind of talk through this from our calculator itself. So again, we've already talked about the 20-year cost of ownership. The total present cost of owning a system, including all of investments. So again, that is here for the baseline. And again, the cost to the building and the cost of the university in this instance are the same because we're using Longwood systems. So they're not in the Cambridge district. Our 20-year cost of ownership for alternate A, which remember is the mercury vapor lamp, not the LED, is much higher. So we're already losing money. So our net present value is negative in this instance. We've got a much better situation. It's only going to cost us $94.95 to own the system. That's initial purchase and all utility costs fold up, escalated, and discounted appropriately. Compared that to $10,952, so we're saving some money. We're saving approximately $1,500 by going with this LED system, including a GHG savings of 2.67. So again, there's clear savings going on there. When we look at our simple payback analysis, this looks really bad because remember, this is the issue where we were looking at just the utility cost versus that initial $8,000 additional costs. So it's saying this is going to pay back in 137 years. But when we consider everything, when we look at our net present value over time, which is this graph. So this graph pretty much represents our cash flows after discounting relative to our baseline. So what this says is we're actually paying ourselves back in year 16, roughly around year 16. So this is time in years, this is money in net savings. So remember, we spent $8,000 in year one. And one thing I should point out with this system, it actually pays back better than this. I didn't think about it when I set it up, but I actually went with less conservative or with poorer pricing than what we actually saw. These are probably closer to $1,800 if I remember correctly, and this was somewhere in the neighborhood of $7,500. So 10 years, 1,800. Yeah. So let's look at it. It's slightly better at about 14-year payback. So with that in mind, we get a little better there. Our first year return on investment is quite low. Then when we look at the utility cost savings, so we can't actually calculate a savings to investment ratio because remember, all of our savings was in materials. So it turns out that our total investment costs, when we consider those materials and those initial costs, was actually lower than our baseline. So you can't get a savings to investment ratio on a negative figure, a negative investment. So the result on that is that we kind of gray it out and say your total investment's less than zero. That's good, essentially. Our discounted payback period, when we don't have ongoing material costs, it will calculate this intersection for you perfectly. The reason we ask it whenever we do have additional material costs, we just refer to the graph, because you could end up in a situation where the calculation would look where it crosses the x-axis, but it could be a situation where, oh, I crossed the x-axis and then I have to invest more money and then I cross it again, and you kind of want to identify the last time it crosses the x-axis. And honestly, it's just very easy to visually verify kind of where your discounted payback period is. So this chart is really telling you a lot. Now, here's a key factor too. So this is looking at the overall adjusted internal rate of return. This looks at what is our rate of return if we did not have a discount rate. So if we were not discounting for the time value of money, because remember, all of these savings are being docked essentially 8% a year because we're comparing it against a hypothetical investment in the endowment. So I want you to see what happens when we change our discount rate. So let's drop this down to 0.25%. 0.0025. 25%. Very, very low discount rate, effectively zero. Look at our results now. We're seeing a much quicker payback period. This, assuming you weren't investing that money elsewhere, we would see a payback period somewhere in the 10.5-year range. We have much better savings overall, almost $13,000 of savings, because we're not discounting for those costs. So the result there ends up being much better, and this is frankly a little more realistic of what your cash flow would be. Again, this is a financial tool that's being used to determine the value of potential investments, is how a life cycle calculator is used. So the finance working group strongly believes that we need to keep this discount rate in here to keep us conservative. So the reason I keep stressing this is because it's important for people to understand that this adjusted internal rate of return is sometimes a more true picture of what you're going to have over 20 years than your kind of net present value and your savings to investment ratio because of that discount. However, it also kind of gives us a buffer by having that 8% discount rate. We see this 15. We can be fairly confident that, if our assumptions about escalation rates are wrong, we've kind of got an 8% buffer. So we're doing pretty good there overall. So that discount rate is really key. Finally, I want to get to the GHG savings. Again, not huge GHG savings, but we're looking at just one microscope. There are hundreds, if not thousands, of these microscopes across campus. So if we ramp that up and put multipliers, we would see much bigger savings. So we're really strong in hopefully getting these deployed. I think we've got some pilot projects going with the medical school now. So we can see just in raw numbers how much are we saving in tons. But then I want to talk about some of these. These are some interesting metrics as well. So how much does it cost us per greenhouse gas saved overall? So this is looking at the 20-year investment cost divided by the 20-year GHG saved. So in this instance, we actually have a negative investment cost. Remember, because of all those materials expenditures, we ended up with less money in our LED situation than we did in our initial situation. So we're actually spending $500 less per GHG saved in upfront capital costs and expenditures and investment costs. The other way we look at it is NPV. So how much are we saving per unit of greenhouse gas saved? So in this sense, we're NPV positive. We're saving about $2,100 a year, $2,100 total to the university. So we're saving nearly $800 per MTCDE saved. So this is the net present value, which remember includes everything. So it's really this $497 kind of the savings added to our utility savings and other non-investment related savings. So these factors matter more when you have kind of bad situations, frankly. So this is obviously kind of a slam dunk. It's costing us less over time and initial investments, so our first costs are lower. Our and total investment costs are lower, as well as we're saving more on utilities and other things as well. So this makes sense for both angles. If we got a situation where that wasn't true, let's say this costs $50,000, so a much bigger investment cost than we look at it. Now we see, okay, so let's say we get into a world where there's no more low-hanging fruit, there's no more really good financially viable things that are both going to save us money and save us GHG emissions. That point will come at some point. We're not there yet. There's still plenty of opportunities on campus both to save money and reduce emissions, but eventually it seems reasonable that that's not going to be the case at some point. So if we had multiple measures, we could start to say, okay, So this is an NPV positive, right? We're losing money if we go with these LED microscopes, assuming they cost 100,000 or 50,000 or whatever I put in right there. This tells us, okay, well, we're still getting GHG savings though. So it's costing us $15,000 per greenhouse gas saved. Now we could compare that against other NPV negative projects. So maybe we have something that doesn't cost as much, but it saves less GHG, or maybe we have something that costs way more, but it saves a ton of GHG. We now have a single metric where we can kind of rank these and say, okay, if my goal is reducing our greenhouse gas emissions by 100 mtCDE, what are the 10 cheapest measures I can implement in order to reach that? And this allows you to kind of rank those in a way for essentially bad economic projects if you get to that point. So there's a bunch of ways to kind of parse this data and use it. So that's pretty much a holistic overview. One thing I haven't pointed out yet that we haven't talked about, one of the big improvements, we recently updated this, one of the big improvements on our end as someone who reviews this a lot is we've provided ample space and priming questions for getting the cost assumptions, the annual consumption kind of assumptions, all of that information directly into the calculator. We would often receive these calculators from engineers with little or no kind of guidance on what the underlying assumptions were behind it. So, has labor been included? If we're providing new gas service for a boiler, well, did you include those trenching costs to get the gas line out there, or are we just looking at the boiler replacement? So it allows us to start asking smart questions about what's behind the numbers to make sure we're getting a really accurate picture. So we strongly encourage anyone using this, and from our own perspective, when we do LCC, we like to fill this out too, just because if we go back to it at a later time, it's easy to forget, oh, how many hours were we saying this was running? How many lamps are we saying we're using? There's a lot of ways we could get to 8 kilowatt hours for this 4-watt system. There's a lot of ways we could get to $1,800 and a 10-year payback. Is that just the lamp, or is that the whole system? These are things we'd want included in these cost assumption notes. And then on the results side, we have places to kind of say, a lot of times there are reasons you would pursue something that wouldn't necessarily be reflected in these above figures. So, maybe this measure provides increased thermal comfort for the occupants. Maybe it results in higher productivity of workers. Maybe it's better indoor air quality that would be considered. So some of the non-financial are tough to quantify elements can be here. And finally, just getting whoever's preparing this opinion on, did this system work for them or not? Do we recommend just kind of overall analysis? What is our guidance going forward, so that the person reviewing it can have some idea of the thoughts of that person. With that, we have pretty much covered the use of this Lifecycle calculator. We've been through a lot of these things. There's more details on these slides. This slideshow is going to be available wherever this video is available. So if you don't have it in front of you, I can assure you there's a download link somewhere near where you found this video. And we've talked about a lot of these already just using the calculator, so I'm not going to go through those. But again, I think it's important to remember that cost isn't everything. There are plenty of good reasons to pursue greenhouse gas reduction, even if the economic payback isn't stellar. However, we're always trying to strive to use the most effective use of our dollars, because that is the more effectively we use our money and get that paid back, the more able we are to implement additional measures. So you always want to start with those things that are really going to have quick paybacks, quick returns first, to the greatest extent possible. And so with that, I hope you guys have enjoyed this, and please feel free to contact me with any questions, and enjoy using the calculator.